Hi, welcome to the Market Alert for Thursday, the 11th of July 2019. It's absurd. S&P tops 3,000 as Powell promises rate cuts are coming. So he's acquiesced to Trump. No surprise there. Word in the boardroom. And yesterday, as we just go through this, there's a lot to cover today, so just to warn you in advance. So here we've got the start of it all. Did the Fed jump the shark entirely with their non-data dependent rate cut that was so exposed today? The most dovish rhetoric since 2017. So let's have a look. Yeah, here we go. This. I'm not going to go through all of this, by the way. It is very difficult to look at these markets and listen to Jay Powell and make any sense of it, exclaimed CNBC's Rick Santelli. And he's always been a big fan, actually, of the Fed. Even the typical cheerleaders, as it says here, are losing faith. None other than CNBC's Steve Leisman asked rhetorically, at 3,000 on the S&P and 1.83 on the 2-year, how much looser do financial conditions need to be? I mean, it is just insanity. It really is. As it says here, Powell spent the morning explaining how much uncertainty there is and why that means a rate cut is urgently. Now, it's urgently needed. He was going to increase rates at the beginning of the year. Trouble is, stocks don't care in the least. So I'm just going to... this is the bit I was after. Perhaps even more note, even the Fed is waking up to the fact that it is, in fact, manipulating the markets. They've been doing this since 2008. As anybody who's looked at the market overview since then will see that, as I keep saying, they want the markets higher. They have a vested interest to do this, and in particular as we head into the next round of US elections later on in the year. Well, not the elections, but the precursor to it, the campaigning. Trump wants the markets on the highs, and there's no doubts that he's had a word in the boardroom. But as it says here, while overall financial conditions remain supportive of growth, those conditions appear to be premised importantly on expectations that the Federal Reserve would ease policy in the near term to help offset the drag on economic growth stemming from uncertainties about the global outlook and other downside risks. Well, mention them then. Of course, they're not going to do that. But as we go through these charts, I mean, this disconnect here in the S&P and the 10-year yield is absolutely telling. I mean, this shouldn't be. You can see how there is a disconnect that is being created. Let's have a look. Nasdaq closing at all-time highs on the day, but it was the S&P crossing above 3,000 that made the headlines. Attempted 3 times, but failed to hold on the S&P. And the one I was looking for, FANG stocks, that's Facebook, Amazon, Netflix, and Google. They're also back at all-time highs. 10 yield, and the one I'm after, as we'll see in a minute. But while the curve steepened, the 3-month and 10-year, this is the one that we use to gauge the forthcoming, or to predict the forthcoming recessions, remains inverted for 35 straight days. Now, I've been doing a bit of work on this as well, and this is the chart I've created. They make the data available free of charge. And I thought, why not? So I've created these charts because it's easier to see. So this is when the yield curve inverted originally, and you'll know from previous market alerts that when this happens, so far we have 100% accuracy with regards to this relationship forecasting a recession, which generally turns up about within 12 to 18 months later. This is probably what's on Powell's mind. So you can see there that 35 days is very easy to see when you actually color code the charts. I'm a visual person, and I have to make everything so that I can see instantly, as opposed to the graph that we had before with a line chart. And this is the long term, so you can see where the recessions came in after the yield curve inverted, and this is where we are. at the moment. So what can't speak can't lie, in my opinion. The other thing I just want to go to, which is still related to the bond markets, is if I can find it. It is here somewhere. There we go. Redefining high yield. There are now 14 junk bonds with negative yields. This is in Europe, by the way. This is Europe. And as it said, just yesterday reported that in a world drowning with liquidity and where over, get this, 13 trillion in sovereign debt is now trading with a negative yield. Italy scrambled, as it should, to sell 3 billion in 50-year bonds at a time when both Spain and France also auctioned debt at record low rates. And this is before the criminal Lagarde gets there. This is under Draghi. There was something that was really interested in this. If I can't find... Oh, here you go. This is it. Yeah. Bloomberg notes the number of euro-denominated junk bonds trading with a negative yield status until recently associated with ultra-safe sovereign borrowers is now a mind-blowing 14. Just 6 months ago, at the start of the year, there were none. So you can see what's going on behind the scenes and why it's important that I get this across to you, that we are heading for a financial catastrophe down the line at some point. I don't know what's going to happen. They're going to keep this kicking the can exercise that they've done since 2008 down the line until they can do it no longer. But this is very interesting now to see this happening. And here's all of the junk bonds that they've actually listed there as well from off Bloomberg. And also here, just to finish with the bonds, what's certain is that the number of negative junk bond issuers will only increase, and that's the point I'm making. On Monday, the ECB said it's ready to add more stimulus to the Eurozone, indicating that an end to Albert Edwards' ice age of ultra-low borrowing costs is far from over. In fact, it's only just starting, and by the time it's over, central banks will own, well, everything paid for with money created out of thin air. And I will leave that with you. So that's the bonds. Let's move on and have a look at the Dow's reaction yesterday to Powell's comments about reducing rates. All of a sudden, the market took off in the pre-market session. They actually moved the item as well. It was for 3 p.m. if you look at yesterday's market alert, and they brought it forward to 1:30, which is why you're seeing this spike in the pre-market session. Most of the Dow move was put on in the pre-market session. We had a buy signal in the first part of yesterday's session. There you can see the market, but only trading up the 20 points there before the market then reversed and started to move back towards the downside, then with a sell signal as well before the market found support and then traded sideways for the remainder of the session. The Dow on the overnight is still above the 200 bar moving average and trading sideways at the moment, heading back towards there at the moment, but as long as it stays above the DP and the 200 bar. It didn't in yesterday's session, by the way. It actually dropped below before, as just to show you, and then it moved to the upside as soon as Powell opened his mouth and sent the market moving to the upside, having been painted into a corner to get these rates reduced. And there you'll see in the pre-market, the market trading below after recording the market alert yesterday morning, came back, had a look at it, then moved lower, went into a range. Powell speaks and bosh, off we go to the upside there. News today, we got Barmy Carney today, another crook out speaking at 11 a.m. And we've got Powell out again today, but I think he did the damage yesterday, 3 p.m. That could be changed to 1:30. In fact, let me just double check this with Forex Factory just to make sure. You see, this is a bit of a difference here. They've got it down now as... oh, it's yesterday, that's why, Keith. Let's just go forward one. 3 p.m. So at the moment it's 3 p.m. It could change, but that's what they did yesterday. 3 p.m. for Powell again testifying. But like I said, I think the damage is already done as far as yesterday is concerned, unless he's going to have 2 days of talking about reducing rates. Who knows? Maybe questions on what he said yesterday. So the pound yesterday moving higher because the dollar moved lower. That's as simple as this. You can see through the 200 bar, market comes back, retraces nicely, finds support here, and then through, and has been making its way higher on the overnight as well. So the US dollar struggling a bit, unless Powell says something today to reverse that situation. And then Bitcoin had a bit of a hammering overnight. Apparently, according to the news on Powell reducing rates, I don't see where the relationship is at all between these two. I think it was just an excuse to bring prices to the downside, which you'll see here. Yesterday it started. We had this spike in selling here, the market coming off the high in this bar. Then we had a sell signal, and then the market eventually breaking through the 200 bar moving average and moving lower. Something that I am working on at the moment, working on a lot of things at the moment. I've never been so excited about different things. The 200 bar moving average has really sparked an interest, and I'm looking at all sorts of things. It's like a magnet, the 200 bar moving average. It seems to draw, markets move away and then they come back. So at the moment I'm experimenting with quite a few standard deviation calculations to see where the market will actually stop. And did a few bits and pieces yesterday. Won't show you today, but it actually forecast where that spike in the Dow would stop yesterday. But there's a lot of work to go on this yet. It's in its early stages, but it's very interesting again because of what's this pattern. And it's something that for years I've noticed that if we can spot a pattern, then we can build something around it, and that's what I've noticed with this. And also it will anticipate the market being drawn back to this sort of magnet that the 200 bar moving average has. It's a bit like the moon and tidal waves. It's amazing. Once it moves away, then it's how far away it moves beyond the mean to then come back. So yeah, very interesting developments. But the Bitcoin market there, you can see moving sharply lower yesterday, and the news apparently is back to the 12,000 area and below at the moment is because of what Powell said, which again I'm not really buying that. And then finally let's have a quick look at implied volatility. Again, I've done a lot on this in the last couple of days as well. I'm not going to show you the latest charts that I've done, but I've actually worked out a relationship in this that actually predicts and forecasts a potential correction as well when something happens in the implied volatility and the underlying market. And I will show you this going forward once I can confirm in real time that what I've spotted works. It's fine historically, but there's no benchmark for forward testing. So as it unfolds, I will release it in this market alert and show you what that relationship is. So I think that's it for today. We've got Deutsche Bank. The only thing that was making the news yesterday is that the chief executives and the board of directors at Deutsche Bank have been spending the bank's money on new suits, 1,900 euros a piece. So everything's fine as far as the directors of Deutsche Bank are concerned, and no surprise there whatsoever. Again, we see with Deutsche Bank, get rid of that. Well, that's come up. Get rid of that. We can see that the magnetism of the 200 bar moving average, again, prices being drawn to it as they are drawn to it this way as well. And then move away and then move back. Okay, that will do it for this one. A bit of a long one today, but a huge amount of stuff going on at the moment. Some very interesting and exciting times as well. Thanks for watching. See you in the next one.